Welcome back. So Uber's in the news again. Are you surprised? This is a company that's incapable of staying out of the news. In fact, for a long time, I thought it was part of its game plan is to stay in the news and look like a rule breaker because that's how they delivered results. Well, this time I think they've really done it. It's been a really bad week for Uber. I'll come back and review the week, but before I do that, let me give you a little bit of background in case you're not familiar with Uber. Who isn't? But you might be one of those people who's lived under a rock and has no idea what Uber is or what it does. It's a company that's come out of nowhere. It was founded as Uber Cabs in 2009, and in 2016, the company had gross billings. Remember, the way Uber makes money is when you take an Uber car, you get charged a certain amount. That gross billing reflects the total charge. But since Uber gets a share of that, their share is called the net revenue. The net revenue in 2016 was $6.5 billion. That's up from almost nothing 5 years ago. And you can see essentially the company's come out of nowhere. Of course, it's still a money-losing company. We'll come back and take a closer look at it. But this is a company I've been obsessed with. Perhaps I was going to say fascinated, but it's really obsessed with for the last few years. In fact, my first valuation of Uber was in June of 2014. I valued it as an urban car service company. Now, one of the things you're going to notice with my valuations is, especially with Uber, the story you tell about the company will very much determine its value. And in 2014, the story I told about Uber was that it was an urban car service company. An urban car service company with local networking benefits that would attract new users into the urban car service market and be able to continue to do what they did. Keep 20% of the gross billing and essentially grow without owning the cars or hiring the drivers. The value I got was $6 billion. And I was taken to task for how narrow my vision was. And you are absolutely right. In fact, Bill Gurley, when VC at Benchmark, lead player in the Uber growth story, told me how cramped my vision was. And he was absolutely right. A year later, I revalued Uber with a much bigger story. Not as an urban car service company, but as a logistics company, moving, delivery, car service, much bigger market. Gave it a much higher market share because I saw at least a pathway to global networking benefits where it wouldn't just dominate a city but could dominate entire regions. And I did bring down their profitability margins because I could see how intense the competition was getting. It was getting to be a global business. It was getting to be a more competitive business. And the value that I came up with for Uber 1 year later, this is 1 year, just a year and 3 months from my original valuation, was $23.4 billion. So if your question is, how can intrinsic value change so much? If your story changes, your value will change. What am I going to do? The value is $23.4 billion. In August of 2016, I revisited Uber. This was right after they exited the China market. The China market was a market that Uber really, really wanted and spent billions of dollars trying to conquer, but finally gave up on, I think sensibly. Sold their stake to Didi Chuxing in return for 20% of Didi Chuxing. So it's given up on perhaps the biggest ride-sharing market in the world, but in return, it's cut off that cash burn that it was having in that market. I revalued Uber, and I concluded that getting out of China might have been the best thing they could have done. The value I got was $28 billion. If it looks higher than it did in September of 2015, it is, but the difference is because of the 20% holding in Didi Chuxing. So my value for Uber has gone from $6 billion to $23 billion and pretty much stayed at $23 billion in August of 2016. That was just a few months ago, 9-10 months ago. You can know what can happen in 10 months with Uber. A lot can happen. Let's see what's happened if you update the numbers. Updating the numbers, here's what Uber told us in 2017. Incidentally, much of almost all of the numbers I've used in all of my valuations through 2016 reflect leaked numbers because Uber is a private business. You don't have access to financials. And because they're leaked numbers, you've got to take them with a grain of salt because somebody's leaking. And when somebody's leaking, there's always a motive behind the leaking. In 2017, for the first time, Uber actually offered fuller financials to Bloomberg to take a look at. And here's what they revealed about 2016. They claimed to generate more than $20 billion in gross billings in 2016. And I'll take them at their word because why would they want to lie? They claimed that their share of of that $20 billion was $6.5 billion. That's almost 32.5%, right? But I thought Uber gets only 20%. Well, it turns out that there was a little sleight of hand here. Uber counts all of its billings from Uber Pool, that's the other service that it offers, as part of its net revenue. Don't ask me what the rationale there is. But that could explain why it looked, so the true share of the gross billings is probably closer to $4.5 billion. But let's take the $6.5 billion and take it for what it is. but the company continued to lose money. It lost about 2.8 billion in 2016. And that's a charitable look at their losses, because that actually did not count the $1 billion they lost in their Chinese operations, which they'd cut off. So here's what we're getting to know about the company. More of the same. Fast growing revenues, big growth in net revenues, and losses continue to mount. Now, investors, though, don't seem to be hurt by the losses. They don't seem to be worried about the losses, because if you look at the pricing for Uber, the pricing for Uber has actually increased over time from about $3.5 billion in 2013 to $17 billion in 2014 to $50 billion in 2015 to almost $70 billion in 2017. Investors don't seem to be faced by the losses. So my stories and my valuations are really of no consequence here, because if people are willing to pay $70 billion, it is what it is. So that's where we were last week when the blank hit the fan, right? Incidentally, one reason I think the company is having so much trouble converting its revenue growth into profits is its original plan, I think, was to create what I call the shock and awe strategy, which is to throw so much capital at the game that everybody else would leave the game to them and they could just end up ruling the world. World domination was Uber's original objective. Unfortunately, the competition has not cooperated, and competitors have actually adapted to Uber's advantages. Some, like Lyft, have decided that they're going to go small and focus on a portion of the market. Lyft decided to go back just to the US, abandon its international ambitions, and it's actually done pretty well by focusing just on the US. It actually is expected to, it increased its market share in 2016. It's actually expected to turn profits sooner than Uber does. So some have adapted. Others, like Didi Chuxing, have fought Uber on their own turf. They said, you can raise capital, we can raise capital too. You can burn through cash, we can burn through cash as well. So with their pricing, which is close to Uber's, Didi Chuxing is willing to go head on with Uber, not just in the Chinese market. The Chinese market, of course, is not an issue, but Didi Chuxing has ambitions outside China. In some of their competitors have tailored their services more to the local taste. Ola in India, for instance, much more tailored to the Indian market than Uber has. So Uber's quest for world domination has hit a few bumps. So, but at least at the moment, you can see that the numbers are telling the same story they've told about Uber for the last few years. High revenue growth, tremendously dynamic company, can't figure out how to make money. So here's where the extracurricular stuff comes in for them in the last few months. It started with Uber being pretty open about the fact that they wanted to be in the driverless car market. And that's a technology business, and Uber doesn't have an advantage. They tried to hire the Carnegie tech people to build them the driverless cars, but the reality is Google's way ahead of them in the game. So Uber actually, with a lot of fanfare, hired away Anthony Lewandowski, who is a Google employee in the Waymo business, that's their electric car business, and he came over to Uber, and there was a lot of publicity when this happened. But it turned out that he brought with him some trade secrets from Google that he was not supposed to. Google sued him and claimed that Uber was in on it, and that's probably, I don't know whether that's true or not, but Uber in a sense admitted that this was a problem because they fired Mr. Lewandowski after they got sued. So there was a Google Waymo legal tangle, and my guess is Google's plans for the driverless car business, at least for the moment, are stymied by the legal consequences of that. The second, and this is a small episode, but it's revealing, was the YouTube video of Travis Kalanick getting into an argument with an Uber driver. Why the CEO of a company would get into the argument with somebody who's that low on the pecking order, I don't know. But he should have known better. But he got into this argument where the driver, I think the driver had a point, because he said Uber squeezes the drivers by pushing down fares. And anybody who's taken an Uber car knows that this is pretty much true in much of the country. And Travis, of course, disagreed with them, got caught on the YouTube video. Small episode, but it kind of fed into the perception of an immature company, a company that acts like a teenager, lots of potential, but lots of problems as well. And then, of course, the biggest problem was a blog post by Susan Fowler, who was an ex-employee of Uber. She was an engineer. And she wrote about her travails at Uber, and it is a horror story. I mean, you read that blog post. The story is not just about sexual harassment. It's about the fact that Uber did nothing to help her. She posts and it becomes an overnight sensation. People read it across Silicon Valley. And again, it feeds into your perception. The reason people believe it is knowing what you do about Uber. You say, hey, that fits what I think about Uber. That blog post, more than any other, triggered a reaction. The reaction was the company could not ignore it. They hired Eric Holder and Tommy Albarn, two lawyers, to take a look at their insights, to let them know what was wrong, whether there was something wrong, and to make suggestions. You hired two lawyers, you asked them for suggestions, you're going to get a laundry list. And they came back with a laundry list of 47 recommendations. I won't list out the other 46, but here was the very first one. He said, they said Uber's board of directors should evaluate the extent to which Travis essentially was imperial CEO, that every decision he had to blow, that they should really take away some of his power. Now, that report came out last week, and the day after it came out, Travis Kalanick announced that he was taking a break. He was taking a break from the company for a period. He didn't specify for how long. And in typical Silicon Valley fashion, he said that he was going to create Travis 2.0. Hey, it's software, right? It's just upgrade. So he left the company, and he left it in the hands, at least as of last Tuesday, of 13 people who used to report for him. So basically, a committee was going to run Uber. In a follow-up meeting where Arianna Huffington called with Uber employees to explain to them how Uber was going to turn a new leaf and become less sexist and more welcoming, David Bonderman, TPG founder, director at Uber, quipped that if you have more women on the board, it'll just lead to more talking. Talk about being stone deaf, and he had to resign right after. So no announcements were made for a while, but today, if you were reading the papers or looking at the news stories, you probably saw the news story that Travis Kalanick has announced that he is resigning. So for the moment, we have no CEO. So if you look at the company right now, it's headless. It's got all these problems around it. And of course, there's talk about it being doomed. Now, I've heard this story over and over again. There are people, I think, who want Uber to fail. So every time something like this happens, they're out there. They're saying, this is it. This is what's going to cause Uber to flip. So I decided to take a look at whether this could be the tipping point. I use the framework I use when I do valuation. Because remember I said especially with a company like Uber, your value is driven by a story. Here are the three things that can happen to your story. You can have a story break. That's the doomsday story. If your story breaks, your valuation is defunct. You can't use it anymore because something fundamental is broken in the company. You can have a story change where something has shifted. Your story has to change in significant ways because of new story. Or you can have a story shift where your story stays the same, but the contours change. So you can have a story break, a story change, or a story shift. A story break is catastrophic for evaluation. A story change could cause a big shift in value. A story shift will basically mean a small change in value. The question is, this last week, is it a story break, a story change, or a story shift at Uber? And the only way to answer this question is to look at all the different players that make up Uber. Uber is a company, but it's dependent, in my view, on 7 different players to make it work. Let's go through the list. For their operations, they're actually dependent on customers downloading the app and calling an Uber car, drivers to deliver the service, and regulators who decide whether they enter or exit markets. 3 players in the operations side. On the business side, they of course need management and traditional management employees, and they need engineers. I mean, this is a business that still needs the service to be delivered efficiently to those customers with apps. So you need managers and engineers. And this is of course a company that's sustained by cash flows from investors keeping them afloat because they have negative cash flows. They need capital access. That comes from venture capitalists, historically who started off these companies, and increasingly for Uber because they've become so big, public equity investors like mutual funds, investors like the Saudi sovereign fund. So I decided to ask the question, how could these players affect Uber because they're reacting to this news? Let's buy item by item. Let's start with the customers. It is possible that customers reading the news stories about the sexual harassment at Uber will get so disgusted that they will delete the app and not use the product. That's going to cause less revenue growth, affect them on their top line. It could be that drivers reading this news decide to quit Uber and go to, a different car service company, back to driving taxi cabs. Well, that could hurt Uber because they don't have the service. They can't make the revenues. It could also push up their costs because they might have to pay more for drivers to drive to them. Regulators could look at the news story and say, oh, Uber is a terrible company. We're not going to let them operate in New York or Los Angeles or San Diego. That could affect the revenue. So regulators, customers, and drivers could affect revenues and operating costs. Managers, the fact that they're being run by a committee, at least for the moment, could also mean that they have to slow down. They can't be as aggressive in making big decisions because decisions by committee always take longer, and big decisions might take even longer. So maybe they'll get less aggressive about going for growth, which could hurt the value of a company like Uber. If Susan Fowler is right, and engineers are being treated badly, and it's entirely possible that the environment is so toxic that engineers decide that they will not work for Uber anymore, or to get them to work for Uber, you got to pay them more. It's going to show up as higher costs, lower margins. Finally, the investors are a big part of this game, because without the capital continuously flowing in, the company cannot survive. So you need continued access to capital, primarily from public equity investors. And it's entirely possible that reading these news stories, a Fidelity or a State Street will not be as willing to jump in and put their money in an Uber. And venture capital is, of course, terrified. They've got too much money at play here. I mean, if you think about it, these are investors who invest in Uber when it was a $2 billion company, a $1 billion company, a $3 billion company. They were looking for a gigantic payday. These are exactly the investments that make venture capital portfolios look good. So if they get panicked by what's going on, maybe they'll rush Uber into an IPO sooner than it should. So in a sense, you can see that there's a potential for this crisis to affect all 7 groups. Here's your doomsday scenario. 20 million users delete their apps. That's half of the Uber user pool. Half of Uber's drivers leave and go to a competitor. Regulators shut them out in 20 countries. Investors basically want their money back. They refuse to supply more cash. Is there the possibility of a doomsday scenario? Absolutely. It could happen. But I don't think it will. And here's why. Every single one of these groups gets as much from Uber as it gives to Uber. I think each of these groups, self-interest is going to lead them to stay in the game and keep Uber afloat. So let's go group by group and see why. Drivers drive for Uber because they need to make money, right? They need to earn a second income. They're not doing this because they love Uber. They don't do this because they love driving. They're doing this to earn a living. So if you take into account how drivers have perceived Uber before the last week, before the troubles, so we can describe these as the troubles, they've seen Uber in its truest form. Drivers have no illusions about Uber. They realize how ruthless the company is. And when they read these news stories, they're saying it took you so long to find out. We've always known this about the company. Let's take the customers. I don't know about you, but I have an Uber app on my phone. I don't use Uber very often, but people use Uber because it's cheap, it's convenient, and it's quick. If it continues to be cheap, convenient, and quick, do you really think that millions of people are going to delete their apps? It's an extraordinary. I mean, you cannot. When you make an argument based on morality and it competes head to head against economics will always win. How many customers do you think will actually delete their app if it means that they have to stay 25 minutes longer at the airport for a ride-sharing service? I might be cynical here, but I don't see customers deleting their apps in the millions. Even that famed, remember the delete Uber thing that happened a few months ago? You know how many people actually did delete Uber? 200,000, less than 0.5% of the number of, less than 5% of the number of users that Uber has. So I don't see customers leaving in droves. I don't see drivers leaving in droves. You're saying, what about regulators? They can shut Uber up. Hey, they've tried, right? They've shown everything but the kitchen sink at Uber, but they've not succeeded. And there's a reason why. As long as Uber has millions of customers, regulators are going to be terrified of trying to shut Uber down because they're going to get backlash from the customers. So unless you get significant numbers of customers leaving, regulators are going to use this as one more tool to slow Uber down, but they're not going to be able to. So from an operation standpoint, there'll be a few bumps, but I don't see this as fundamentally changing Uber's operations. Let's turn to Uber's business. It's true that for the moment, Uber has a committee. Now that Travis is left, I think there's going to be a new CEO. I think managers are not going to abandon the company. They have too much probably tied up in the company's equity. They need the IPO to be successful, to be rich. They're not going to leave now. And I think there's an open question of what kind of CEO will come in now. It is possible that the board of directors are so terrified of the juvenile CEO model that they're going to go after some kind of corporate CEO. That would be a mistake if you ask me. Uber is a company built on rule breaking. You can't have a rule follower run the company and expect it to be a valuable company or as valuable a company. I think that they are, I'm sure, shell shocked. The managers right now are shell shocked about what's happened the last week. But I think they'll figure out a way to move on. And part of the reason I think they will figure out a way to move is they probably share a lot more in common with the company culture than you think. I mean, this is a company that self-selected its managers. These are not managers who came in expecting to be working at Disney. They came in expecting to work at a rule-breaking company, and they got exactly what they expected. So there might be some shocks to the system, but I think the managers will stay on. The engineers, I say I'm not a software engineer. I don't know how they think, but I seriously doubt that engineers are going to not come to work at Uber. Again, I might be cynical, but if you gave engineers a sufficient pay packet, an exciting job, and lots of resources to write whatever interesting things they have to do, my guess is you're going to attract engineers. You might have to pay them more, but I don't think you're going to end up with no engineers working at Uber. So from a business standpoint, there's going to be some shaking, but it's going to hold. It's on the financing side that I worry, and here's why. As I said, the venture capitalists are waiting it out for the IPO. They want to cash out. The public equity investors are also waiting it out for an IPO, but Uber is dependent on them supplying them more cash to go on. Is it possible that public equity investors will stop investing additional capital? It is, but here's what they will lose if they do that. The company will collapse. It'll implode. You have too much to lose. In my view, once you get to, when you're talking about a company with a potential value of 60, 70 billion, these people have too much to lose. In fact, one reason I think Travis had to resign this morning was because he felt pressure from the investors to get out. They have too much at stake to risk it all going bad. So I think they'll find a way to muddle through. But here's where I think you're going to see some consequences. I revalued Uber after all of these news stories, and I put in a few tweaks. I think that that there is a risk, a small chance, but there is a risk that there could be an implosion in the company, especially if there are more bad stories that emerge. I've given it a 5% chance of it happening, where the company, in a sense, implodes and goes away. I think the company is too valuable, has affected too many of our lives to go away. So I value the company, and the changes I put in relative to my September 2015 were relatively small. I updated the numbers to reflect the growth, and it's actually growing faster still than I thought it would. I keep trying to catch up. It's still losing money, so I did put in the losses, and I put in the expected revenues. The value that I get for the company is about $37 billion. And it looks like a big jump from last year. You know why it looks so big? It's because they have $5 billion in cash they've raised since last year. That's now a cash balance, and they have that 20% stake in Didi. So in effect, the company value that I've come up with is not that different from what I got a year ago, which was itself not that different from what I got in 2015. From my perspective, the basic story for Uber has stayed pretty stable through all of this, but it's still, and this is a fairly optimistic view of Uber. The value that I'm getting is about $35 billion. The most recent pricing was $69 billion, and that is where I think there is a danger. And the danger is that this is a company where potential has been what's driven the pricing. I think investors have been willing to look at the potential and have been willing also to ignore the fact that converting that potential to profit is going to be difficult, that there are all these barriers for Uber. They've been willing to assume that Uber will find a way around them. Perhaps, and I'm not guaranteeing that this will happen. Perhaps a seed of doubt has been planted about whether Uber can convert the potential to profits. And that's a dangerous thing in the pricing game, because it's all driven by momentum. I'd be very interested. In fact, I think every investor in Uber and every employee in Uber and everybody who's interested in Uber should be watching this and what happens on the next round of capital that Uber raises, assuming it decides not to go public next. Because if the pricing on the next round is $85 billion, higher than the $70 billion, you're home free. Investors are going to forget all the bad stuff. Everything's going to be fine. If the pricing is at $50 billion, I think that you're going to see a very quick, a likelihood at least, that the price will start to converge on a lower value, more realistic value. I'm going to continue to watch, but I think that it's been a week from hell, but it's not doomsday yet. And the danger, I think, the biggest danger, I think, remains on the investing side, that the investing group will panic and create this spiraling effect that will cause the price to converge on value. But Uber's not going anywhere. If you hate Uber as a company, it's going to be around for you to kick around. If you love Uber as a company, you'll still have the app on your phone and the service to take. Thank you very much for listening.